What is an index fund? An index fund is a portfolio investment consisting of stocks or bonds or some specific kind of investment that's designed to mirror or track the performance of a specific financial index. You might need to listen to that about 2 or 3 times for it to really make sense. For instance, the Standard & Poor's 500, also known as the S&P 500, is an example of a financial index. It comprises of 500 of the biggest US companies quoted on the US stock exchange. So an S&P 500 index fund, for example, is a portfolio that specifically tracks the performance of the 500 companies within the S&P 500 index, such that if you were to invest in an S&P 500 index fund, your money, your invested money, would be spread across the 500 companies that make up the S&P 500 index. And if you understand what mutual funds are, you'll see that from my example, an index fund is nothing more than a type of a mutual fund. Who is an index fund best suited for? Index funds are best suited for people who want to invest in the stocks of different US companies, but without the risk of putting all their money in the shares of just one company. So instead, they invest in an index fund. And by doing so, they've invested in a large number of different companies captured within that index fund. And as a result, the risk is also spread across all those companies. This is good because it's unlikely that all the companies in the fund will perform poorly at the same time. If for some reason some of the companies are down, at least the others will be up. Index funds are also well suited for long-term investors, people who want to invest their money for long periods of time, upwards of 10 years. And because of their diversified nature and because they're generally regarded as being safe, index funds also make for very good first-time long-term investments for beginner investors. What are the benefits of an index fund? As I said earlier, an index fund is a portfolio of stocks, and some index funds have hundreds of companies in them, and as a result, they're diversified and they reduce the risk of investors losing money in them. Index funds have been known to perform fairly well too. From inception, they've grown at an average rate of 8 to 10% every year. Another major advantage of index funds is that they're not actively managed like mutual funds. They are passively managed. So there are no professionals who are hired to manage the fund and to ensure that it performs well. Funds that are actively managed, they usually charge some high administrative and maintenance or management fees from their customers. But because an index fund is passively managed and basically just mimics the performance of an index, it's pretty much automated and the management and administrative fees are very low. Examples of index funds. Now, examples of index funds include the Fidelity Zero Large Cap Index, the Vanguard S&P 500 ETF, the SPDR S&P 500 ETF Trust, the iShare Core S&P 500 ETF, and the Schwab S&P 500 Index Fund. These were also 5 of the best index funds in August 2020 according to Bankrate.com. Thank you guys so much for watching. If you enjoyed this video, please do me a favor and click on the like button. I would really appreciate it. And if personal finance videos are your cup of tea, then you might want to just click on the subscribe button as well. If you do that, be sure to click on the notifications bell too, so that you're notified every time I put out a new video on Wednesdays. If you've done all that, I am in your debt, and I promise you awesome videos in the future. Thanks for watching, guys, and hopefully I'll see you in the next one. Take care.